95% of all crypto newbies lose money, and the main reason behind this is poor risk control skills that may lead to impulsive decisions. So today I would like to talk to you about one thing: risk management, and why it's the most important aspect of cryptocurrency trading, and how to avoid losing all of your deposit on the very first day. Hey guys, Shad here with another lesson in our cryptocurrency course. Please consider subscribing to our channel and pressing the bell icon to stay up to date with all the latest crypto news. The cryptocurrency market is growing at a crazy pace. The beginning of 2021 illustrates this beautifully. In February, the total cap of the cryptocurrency market exceeded $1.5 trillion. Just to compare, back in March 2020, the market cap was estimated at only $160 billion. As the market continues to grow rapidly, many people forget that crypto trading is not only about profits, but also about risks. And if you don't want to drain your deposit on the very first day, you've got to keep risk management rules in mind. The first strategy will help you to make a huge profit and decrease the risk of potential losses. Alright, so let's start with the basics. In cryptocurrency trading, risk is the likelihood of losing invested funds. Therefore, risk management is the ability to predict and control possible losses from an unsuccessful transaction. Why is risk management so important? Here is a simple example. You decide to invest in crypto and board Ripple, a relatively strong and stable project, for your entire deposit. But unexpected things happen when you least expect them to happen. XRP dropped by as much as 50%. By the way, these are not abstract numbers. Just take a look at Ripple's chart for the last year and you will see continuous ups and downs. To sum up, you can lose half of your deposit just by carrying out one single deal. And of course, this is a very dramatic example. Even beginner traders rarely make such obvious mistakes, but the bottom line remains the same. If you don't have a risk management strategy in place and are trading intuitively, you'll definitely be losing money long term. So how do we prevent this and how do we trade safely? Let's take a look at the main principles of risk management in trading and crypto trading. The first rule: don't put all of your eggs in one basket. If you invested your entire deposit in one cryptocurrency and it suddenly dropped by 50%, you would lose half of your investment. But what if you had 10 assets and Ripple was only 10% of your entire deposit? Then your loss would be less significant. Therefore, never ignore risk diversification. Always analyze the market and invest in different cryptocurrencies. Second principle of risk management is estimating the size of the trade. Very often, traders are guided by emotions rather than logic or serious calculations. There is even a special term that describes this phenomenon. It's called FOMO, or the fear of missing out. Inspired by the hype, beginner traders behave recklessly, investing 30 to 40% of their deposit in one deal, which can lead to serious losses when a deal fails. Therefore, don't forget about the 6% rule and the 2% rule. The latter states that you should only open a position with no more than 2% of your entire deposit. Some even recommend investing no more than 1% of the deposit. By using this strategy, you will never drain your entire deposit. The 6% rule says that if you keep losing money in crypto trading and can't stop the series of unsuccessful trades, you should stop trading if you lose more than 6% of your deposit. In this case, it is recommended to take a break in trading for 1.5 to 2 weeks so that you can psychologically recover and stop making rash decisions. It's a timeout for yourself. This principle is closely related to the capital loss limit. When you enter a position, make sure that the total risk for all orders do not exceed 25%. This provides a guarantee that if all your trades turn out to be unprofitable, you'll still have at least 75% of your initial starting capital. And the third key principle of risk management is the determination of transaction profitability. Remember that not all trades will be profitable. Even professional traders lose money. Losing is a part of trading, you simply have to accept it. The main thing to consider is a profit to loss ratio. Ideally, it should be 3 to 1, well, at least 2 to 1. On the EXMO exchange, we offer an analytics section to help you easily track your profitability. You don't need to make manual calculations, just open analytics and you'll be able to form an effective trading strategy. Moreover, learning from your mistakes is great, but at the same time, a very expensive way to succeed. Therefore, we have created and curated a list of the top 3 mistakes of beginner traders. Standard situation: the deal turned out to be unprofitable and the trader lost money. And then comes the desire to recoup everything as quickly as possible to compensate for the losses. This, of course, leads to rash decisions and even greater losses. Never act this way. Record your losses and don't be blinded by greed. Self-confidence is an important skill, but overconfidence can play a dirty trick on you, especially when it comes to crypto trading. Even with the most professional forecast, the deal may turn out to be unprofitable for you, for a whole host of reasons. Often, it's self-confidence that makes traders invest 30 to 40% of the deposit. They're sure that Bitcoin will definitely go up in value, but we are not so sure. Therefore, build the right strategy and do not risk a large amount of your initial deposit. 1. I need to win money back. 2. My crypto will rise in price again. I believe in it. 3. Stop loss and take profit? No. have never heard about them. Another mistake that every newbie makes, and which has already become a reason for memes, is the neglect of stop loss and take profit orders. Let's start with the first one. A stop loss order is an instruction to the exchange to close a trade when a certain price loss level is reached. For example, let's say you bought some ETH for $1,700. You conducted a technical analysis and assumed that the price of the coin would rise. However, we all know the crypto market is super volatile, and therefore you need to protect yourself. For that sole reason, you will need to place a stop order to sell your ETH on EXMO. You give a command to the system that if the price of ETH drops, for example, to $1,500, then it needs to be sold. Thus, you control your risks. Even if the rate falls by 50% per hour, your loss will not be as significant. Now let's get to take profit. This is even more complicated. Very often, beginners do not know how to take profits and close deals when a certain level of profit is reached. Remember, greed does not lead to good outcomes. Determine your take profit level in advance and close the position upon reaching it. The price trend can turn around at any time and you will not only fail to earn, but you will end up losing. So this concludes our lesson for today. Use the tips in this video and do not neglect the rules of risk management. Don't do it. That is, if you don't want to lose all of your money. And of course, if you want to learn more about the crypto market, please like this video, subscribe to our channel, and wait for new informative videos to come out. My name was Shad. This was EXMO Cryptocurrency News. Peace.